There we go. Okay, so thank you for joining me today. Today's program is Prepare Your Farm for Tax Season Now. My name is Florencia Colella, and I am a farm business management educator with Michigan State University Extension. My pronouns are she or they, and I am multiracial. And now some housekeeping. If there's anything you want to express during the webinar, including questions, you may type it in the chat box. You're also able to unmute yourself and show your video if you prefer to do it that way. But please stay muted when you're not speaking. I may have to mute you if there's background noise. If there are any questions that I am unable to answer live, I'll send answers in a follow-up email that you'll receive after the meeting. I have enabled automatic live transcriptions for our deaf or hard of hearing participants. This automatically adds text to the bottom of the video with a real-time automatic transcription. You can take a moment now to turn it on or off. If you're joining from a computer, you can do that by going to the CC Live Transcript button at the bottom of your Zoom window. And on cell phones, settings are just a bit different, but you should be able to find them by going to your Zoom options. We would also like to acknowledge that Michigan State University occupies the ancestral, traditional, and contemporary lands of the Anishinaabe, Three Fires Confederacy of Ojibwe, Ordabwa, and Potawatomi peoples. In particular, the university resides on land ceded in the 1819 Treaty of Saginaw. We recognize, support, and advocate for the sovereignty of Michigan's 12 federally recognized Indian nations, for historic Indigenous communities in Michigan, for Indigenous individuals and communities who live here now, and for those who were forcibly removed from their homelands. By offering this land acknowledgement, we affirm Indigenous sovereignty, and we will work to hold Michigan State University more accountable to the needs of American Indian and Indigenous peoples. Michigan State University Extension programs are open to everyone. We are required to ensure civil rights policy adherence to report program participant race and gender data to the United States Department of Agriculture. Providing this information as a participant is voluntary, but I would really appreciate it if you could take a minute to fill out this form, and I'm copying it in the chat. This helps me show the reach of the work that I do. Individual responses are not shared with the USDA and are kept separate from registration and mailing lists. Please, if you are able, go to the link and fill out the form. If you came to the last session and completed it, thank you. But since this is a different session, I'd really appreciate it if you could do it again. So finally, I would like to recognize that as adults trying to learn while riding the demands of farming and life in general, I hope we give each other as much grace and support as we can. Without further ado, let's get started. Just a second. Okay, before we get started though, in this presentation, I will provide a lot of information. And I also wanted to point out that you should always seek either official IRS information or help from a tax or legal professional for specific guidance. The information in this presentation is provided for educational purposes and should not be perceived or utilized as formal tax or legal advice. Okay. So just moving some stuff around here on my screen. Okay. So today's presentation will be broken down into a few sections, and the first one is tax basics for beginning farmers. So this way we can all get on the same page, hopefully. So last time we learned some about record keeping. That is the art of managing an organization's financial information throughout its life cycle. We said that in order to achieve different goals, record keeping can be done at different levels depending on the amount of information collected. The minimum amount of information to be collected would be what's necessary to file income taxes, and that's what we're going to focus on today. Then we may get a little into financial accounting if there's time. The third level is whole farm managerial accounting, which means that the goal of this level is decision-making at the whole farm level. And the highest level of record keeping is enterprise level managerial accounting or decision-making at the enterprise level. Before a farm can get to one level, they first need to master the previous ones. Some of the advantages of keeping records for tax purposes are that it's relatively simple, it meets IRS requirements, and it is an important set of data that will eventually inform more advanced business analysis. Some of the disadvantages are that it can be a very poor indicator of profit or loss. It provides little information for decision making, and it does not provide information for monitoring financial progress. Here's a few things that you have to do as you get started as a beginning farmer. First, check if your property is already classified as farmland with a township's register of deeds. If it's not, you'll have to file an affidavit, Form 2599, claiming the exemption with the local assessor. There's the link there, which I know you can't click, but maybe I can put it in the chat. Hold on. Oh, well, that didn't copy too well, but hopefully you can copy it and paste it into your browser if you need. So agricultural land may enter a farmland development rights agreement with the state of Michigan that is meant to ensure that the land remains in an agricultural use. And in return, you get some income tax benefits. You also have to register your business with a county clerk. County clerk's office. You have to select what kind of entity you'll be. The most common business entity is sole proprietor, and then you can have partnerships, LLCs, some small business corporation or subchapter S, big corporations, or subchapter C, silent partners, etc. That's a legal decision, but it has tax implications as it's going to determine how the business is going to be taxed. If you form a corporation, profits will be taxed both at the business level and at the individual level, but there's no tax at the business level for sole proprietors, partnerships, limited liability companies, or S corps. The entity is not taxed, the individual is taxed. The farm partnership fills out a form, the Schedule F, and then there's a special series of forms where the partnership profit is sent out to each of the partners. And the partners claim their share of partnership profits on their individual tax return. And they pay tax themselves individually. That's why these are called pass-through entities. Then you need to decide how you will file taxes. First, there's the decision of whether you're running a hobby or commercial farm. And the Internal Revenue Service, or IRS, defines a farmer as somebody who cultivates, operates, or manages a farm for profit, either as owner or tenant. One thing that is tricky is that a farm is defined differently for income taxes, for property taxes, for the USDA, etc. So make sure you follow the right definition. There are no minimum income amounts to be considered a farmer by the IRS. The IRS will presume a farming activity is being conducted for profit if it produced a profit in at least 3 out of the past 5 tax years, including the current one. Equine operations are the exception, with a presumption of profits in at least 2 out of 7 years. If this test is not met, the IRS will consider other criteria, including the extent to which the activity is conducted in a business-like manner, the expertise of the taxpayer or his advisors related to the activity, the time and effort spent, the expectation there may be of assets used in the activity appreciating in value, the success of the taxpayer in carrying on other similar activities, the taxpayer's history of income or losses with respect to the activity, the amount of occasional profits, if any, the financial status of the taxpayer who may be interested in offsetting other sources of income, and the elements of personal pleasure or recreation. Any income from a hobby farm is reported on the first page of the U.S. individual tax return, or Form 1040, under other income, and it is taxable. You used to be able to deduct hobby farm expenses to the extent of the farm's income, but that is not the case anymore. So you will be taxed on your hobby farm's gross income independently from any expenses you incur. On the other hand, income from a commercial farm is reported on Schedule F, which is an attachment to Form 1040, and its expenses are deductible, even if they go above income. So if your commercial farm operates at a loss in some years, those losses can be used to offset your overall income tax liability. If you are audited, the IRS will look at whether you can prove that your goal is to make money from farming. The good news is that the practices needed to show the IRS that you are farming for its potential profit, even if you aren't making money right now, are the same good practices that will eventually make your business a successful one. This is a list of things that the IRS will look at. So keep your farm's bank accounts separate from personal accounts, have a formal written business plan, have an annual budget, keep business books and records, make year-end financial statements and analysis. So just one question. Did you get the links that I posted in the chat box? Were you all able to see them? You did not see them. Okay, let me paste them again. I just realized I did something wrong. Okay, so there's two links there. One is for the form to report your race and gender, and the other one is for your farm to be classified as farm property. Yeah, I will send PowerPoint anyway. Great, thank you. All right, where was I? I think make year-end financial statements and analysis. Also attend extension meetings like this one and read extension or other educational materials related to your farming activity. Consult with professionals, have a membership to a producer association, keep track of the time spent in carrying on the farming activity. All of those are activities that would prove that you are in farming for the profit. So there's the question of what parts of your business can be considered farming for the IRS. Timber, alpaca, landscaping, and pet kennels are not considered farms for income tax purposes. Or for example, maple syrup operations, just collecting the sap is farming because you're producing a product up to its first marketable point. But if you are boiling sap and making syrup, that's not a farming operation, that's a processing operation. Same thing for a dairy farm that may sell cheese, or a winery. For fresh fruits and vegetables, up to washing, grading, packing, cooling, and storage is considered farming, but no more than that. For grains, drying and storage is part of farming. For honey processing, all the way for sale is allowed. And the shearing of wool is also considered part of the farming activities in a sheep farm. Ag tourism is not a farming enterprise. It's a different kind of business. So any non-farm business activities have to be reported on Form 1040 Schedule C, which is the regular business form. Any farm activities go on Schedule F. This makes the bookkeeping slightly more challenging if you have more than just regular farming, but if you have a good chart of accounts, you can handle it. So if you decide to go ahead and set up a business checking account, you need to have an employer identification number with the IRS, and that's pretty easy to do online. If you go to irs.gov, there's a form there, SS4, for you to get an employment identification number. And a final point that I wanted to make for beginning farmers is that there are ways to deduct startup costs. So you want to have your record-keeping system activated fairly early so that you can collect all of your expenses and legally deduct them. Chapter 7 of the IRS publication 535, titled Business Expenses, describes how new businesses can do that. There's also a nice publication for beginning farmers called Publication 583, called Starting a Business and Keeping Records. You can find these on irs.gov. And then you can deduct business expenses incurred during the startup phase up to $15,000 in the first year, and then you may amortize the remaining expenses and deduct them in equal installments over 15 years, starting in the second year of operation up to $60,000. Note that this is for operating expenses, not machinery. For machinery, you've got depreciation, and you can start using that as soon as you place the equipment in service. So in this section, we discussed some basic tax considerations for beginning farmers, advantages and disadvantages of keeping records for these purposes, classifying land as farmland, registering your business, qualifying as a commercial farm for the IRS, and some special tax deductions for new farmers. Let me see if I can copy a couple of the links that I mentioned. Okay, hopefully that worked there. There's a bunch of the forms that I mentioned. And yes, all of this will be in the documents I'll send after the presentation. So let's go to more general income tax considerations for farmers. So Here's a summary of the main topics we'll go through: Form 1040 and Schedule F, the farming form, capital gains or losses, and the form for reporting these, general farm income and expense categories, and a few special categories like custom hire expenses, depreciation expenses, employee withholdings and deductible labor expenses, expenses and property used for personal and business, and what I call invisible transactions for taxes. And we'll also say a quick word about self-employment tax at the end. So this is Schedule F, the tax form for farmers. If you go to irs.gov and search for Schedule F, you'll get the form, and you'll also get information about what's supposed to be on each line. Schedule F categorizes your income and expenses and profit or loss. Farm profit or loss winds up on Schedule F first and eventually ends up on the 1040 individual tax form. This is the federal income tax return 2021. I'm sure that most of you have seen this, or at least you've signed it. The arrows point to wages, which a lot of people have. On line 8, there's a spot for business income, including farming and other business income, which comes through Schedule 1, which is an attachment to Form 1040. And on line 7, there is a place that catches capital gains or capital losses reported on Schedule D. So let's stop here for a minute and define capital gains and losses. So there's different money that a business creates. One is profit from operating. You grow potatoes and you sell potatoes. And the difference between what you receive and what you spend is profit, and that's operating profit. But then you might have a capital asset, for example, a tractor that you buy, use it for a number of years, and then sell it. And you could conceivably have a gain from the sale of that tractor. The dollars from that gain are handled differently than the dollars from operating. So this does not pass through your Schedule F. Any farm assets not held primarily for sale, such as livestock held for draft, breeding, sport, or dairy purposes, whether bought or raised, land, buildings, and equipment fall under here. One of the sales of business property that I'm familiar with is the sale of cull dairy cows. It might be a 5, 6, or 10-year-old cow whose milking life is over, and then she's been an asset on the farm, both a productive asset and a capital asset. And then she gets shipped for beef. That's a sale of business property, whether she was purchased or born on the farm. And so that's money. So that money from that sale is handled differently than the sale of milk from that cow, for instance. Usually business property is on the farm for more than 1 year, and you may have a gain or a loss from the sale of that business property. So there's a special form that catches this information and teases that money out into different categories. It's Form 4797. The sale of business property is not ordinary income. Again, it's generally taxed at a lower capital gains rate, which is a lower rate than earned income. And you also don't pay self-employment tax on capital gains either. So this is a situation where records are very important. You have to have the date of purchase, date of sale, sales price. If there's a trade involved, any expenses made to maintain or improve the asset, how much has been depreciated, and if there has been any casualty losses. This allows either you or your tax specialist to categorize the sale and figure out how much of it is a return of capital invested, also known as basis, how much is the gain or loss, and what's taxable and at what rate. So Schedule F has Part 1, which is operating income, and Part 2, which is operating expenses. And then at the bottom is net farm profit or loss. This is like an income statement or profit and loss statement, but it's not a real good one as it's missing some or a lot of information. Just admit someone.
Today is Monday.
So Joe, I just muted you because we were hearing your voice message. So where was I? So, I was saying it's not a good income statement. It's missing a lot of information. So there are ways to add information to your taxes to come up with a better representation of your income once you've filed all your tax forms, and we'll discuss that later. So farm income on Part 1 includes sales of products raised and grown, products purchased for resale, income from farm-related services like custom work, payments from agricultural programs, etc. The general rule of the tax system in America is that if you get it, it's income. Another general rule is that income is taxable unless it's specifically excluded. Items of income include money, as well as property or services received. So if you received property or services as in barter and trade, you must include the fair market value of the property or services received in income. If you do machinery work or another service as a farmer, the money would appear here on line 7. If you had debts paid by another person for you or canceled by your creditors, you may have to report that or all of it as income. But overall, income is pretty straightforward. Expenses tend to be a little more complicated, so let me show you the IRS publication 225 called the Farmer's Tax Guide. It's got all the information on how the federal tax rules and regulations affect farmers in the United States. It is an annual publication and it's available online from irs.gov. There's 16 chapters in it. I don't know if I put a link to it yet, but yeah, I'll put it in just a minute. There's 16 chapters. The most interesting one is chapter number 4, farm business expenses. And it's a good idea for you to read through that chapter to make sure you're claiming all of the business deductions that you're able to. So in alphabetical order, on part 2, farm operating expenses are car and truck. So that would be repairs or tires or registration for farm vehicles, chemicals, conservation, custom hire, which would be you hire somebody to come onto your farm and do certain tasks. Depreciation, which is a non-cash expense that we'll get into in a few minutes. Employee benefits, feed that you buy to feed your animals, fertilizer and lime that you buy and use on your fields, freight and trucking to either get something that you buy to the farm or get your product to a sales point, gas, fuel and oil, insurance, interest, labor hired, pension and profit sharing plans, rent or lease of equipment, rent or lease of buildings or land, repairs on farm buildings and farm equipment, seeds and plants, storage, supplies, which is a pretty big catch-all. So it could be everything from twine to livestock ear tags to soap and detergents used in the milking room. Property taxes, utilities, veterinarian expenses and breeding expenses, medicines. And then there's another big catch-all, which is other expenses that includes educational programs attended related to the farm, subscriptions, record-keeping expenses, tax preparation, legal expenses, production testing, etc. We mentioned custom hire. If you had custom hire expenses, you have to have enough information, not just to enter an amount on Schedule F, but also fill out and send the 1099 information returns to people that you do business with. Form 1099 has to be filed for each person to whom you have paid at least $600 in rent, custom work, or other types of work, such as a veterinarian, attorney, or accountant. You should give them a Form W-9 to obtain the necessary information from them. And we also mentioned depreciation as some of the farm expenses. Depreciation represents the wearing out of equipment. The idea is that you buy a capital item and it lasts for a long time. So you spread the cost over a number of years, taking a little bit of it in each of the years. You or your tax person will create a depreciation schedule so you can calculate how much depreciation you can take in the year of purchase, how much you can take in each of the years during the life of equipment, and then how much you would also take in the last year of the depreciation. The asset may last beyond its depreciable life, which is fine, but you'd be taking out a depreciation expense for a specific number of years. The IRS has very specific rules on this and how many years and the method, and that's described in the depreciation chapter of the Farmer's Tax Guide. Something to note is that some types of livestock are also depreciable. Remember that purchased dairy cows and breeding cattle can be depreciated, whereas cattle that are born on the farm or purchased for resale are not depreciated. So you've got to keep track of when animals come onto the farm and when they leave and what types of animals they are. So I mentioned a little earlier that the actual life is not the same as the depreciable life in an asset. An asset might be depreciated for 7 years, but it might last for 15 years, for example. Well, there's a couple extra fast depreciation options that may be worth looking into as you do your tax planning. The Section 179 deduction and bonus depreciation are 2 ways to get all or some of your tax break upfront. The theory is that this will lead business owners to invest in capital equipment, so it's supposed to stimulate demand for capital equipment. There's another type of asset that's called listed property, that is assets used for both business and personal use. We won't get into detail, but there's very specific rules about how much of that can be depreciated and over what period. This includes stuff like computers and cars and pickup trucks. Another expense I mentioned is a labor hired. If you have an employee, there's a number of payroll records that you have to keep, and you have to withhold Social Security based on a W-4 form that the employee fills out and gives you when they are first hired, or if they want to make any changes. At the end of the year, you're supposed to provide a Form W-2 to your employee. You have to pay withheld employee taxes to federal and state governments on a timely basis. You also have to pay federal and state unemployment taxes on your employees, which are known as FUTA for the federal level and SUTA for the state level. Wages and benefits that you pay to an employee are deductible business expenses. Same with workers' compensation insurance premiums. You can talk to your regular insurance agent about what the rates for workers' compensation insurance on your employees are. They vary with what your payroll is. You can hire family members, and there are some special rules with them. This is all described in Chapter 13 of the Farmer's Tax Guide. And there's a special IRS publication called Circular E, which is the Employer's Tax Guide, and gets into the fine points and the nitty-gritty. So if you employ people, you need to have an employer identification number, and we explained how to get one before. The employee has to give you a Form I-9, and you're supposed to check certain pieces of information that say that it is legal for this person to be working in the United States and that you've checked. You are not qualified or expected to say whether or not that is a real Social Security card, just that you have seen the card that was presented. Note that inspectors do go out and check to see whether or not people are employees or independent contractors. There's a number of questions that can be asked. And one of them is, does this person do the same service for other businesses? And does this person operate their service as a business? If you have the right to train, direct, or control them, or if you provide the work tools or reimburse expenses and have a more permanent relationship, they are likely an employee. If you need help with employee paperwork, you can hire a payroll service to help you with just that. And some of the services, you can call them and tell them how many hours a person worked for you during the week, and they'll mail a check. So it can be pretty easy. Okay, so next, there are instances of invisible transactions. For example, when borrowing money, cash comes in and goes out, but that's not taxable. Sometimes you may receive a return of capital that you've invested, and that money is also not taxable, for example, on retirement accounts or permanent life insurance policies. So your bookkeeping system has to be able to handle these different types of transactions so that you're not paying more tax than you need to. Another one is the owner's labor. The owner does not usually get paid a wage or a salary except in a corporation. The owner usually takes a draw, but this is not a deductible expense at the farm level, and it's not income at the individual level either. However, you do pay tax on the farm's profit when putting Schedule F income on your individual tax return. Then some expenses are what record-keeping systems call farm and home expenses, where they are partially farm and partially home. Those are things such as interest, insurance, property taxes, and utilities. For example, the town sends you one bill for property taxes, and some of it is farmland and farm buildings, and some of it is your personal home. So you're supposed to tease out and have the farm pay for the farm's proportion, and have you as an individual pay for the tax on your home. Same with utilities. Lots of times there's only one meter going onto a farm, and then the thing is to reasonably allocate between the farm and the family. The same can be true for insurance. Your insurance agent can help you figure out what % of your bills are for insuring farm buildings and farm liability versus insuring your home and your home liability. Then finally, make sure to not include personal expenses. They are like dog food, for example. So it's important to keep track of personal income and expenses that you may need to file your personal taxes. Also, through deductions and adjustments to income, you may reduce what's called taxable income, resulting in a lower federal income tax liability. There are two types of tax deductions: standard deductions and itemized deductions. The standard deduction is a specific dollar amount, while itemized deductions report amounts of certain expenses incurred during the year. In most cases, you can choose the type of deduction that is higher and therefore results in a lower federal income tax liability. Deductions and adjustments to income go on Schedule 1 and Schedule A. So we just said that you can choose the type of deduction that results in the lowest tax liability for you. That is called tax management. you can apply tax management strategies for personal and farm taxes. Tax management can legally lessen your tax liability and maximize after-tax income. To be able to apply tax management strategies, you must understand tax laws and keep good records. So the general recommendation is to avoid wide fluctuations in taxable income from year to year, because a relatively uniform income results in the lowest income tax. There's many tax tools to achieve this, including the delay or not of regular income and expenses or capital purchases and depreciation. But one I wanted to mention is income averaging. This allows negative taxable income to be used from the 3 previous years to offset a higher income year. Another useful tool are Roth and SEP IRS. Finally, a quick note on self-employment tax. This is paid by the owner of the business based on the profit. There is a special IRS form, Schedule SE, for self-employment tax. Sale of business property, rent, and investment income are not subject to self-employment tax. Remember that Social Security benefits are based on self-employment tax paid, so you need 10 quarters of Social Security coverage in order to have disability benefits or survivor benefits in case the main operator is injured or killed. For retirement benefits, you've got to have at least 40 quarters paid in. So if you have many, many years of low profit, it means you're going to have very, very low Social Security benefits. When setting up your record-keeping system, it's useful to look at tax forms. So for example, you can name your accounts the same way as Schedule F items. So it makes it easy to transfer amounts from the accounting system to the Schedule F at the end of the year. The Farm Records Book for Management is a free record-keeping spreadsheet by Michigan State University Extension that can be used on the computer or printed to fill out by hand. A booklet can also be purchased at your local extension office or online at the MSU Extension online bookstore. The accounts in this booklet are designed based on tax categories, and it also includes tables to estimate your Schedule F, Schedule 1, Schedule A, Schedule SE, Form 1040, and the Michigan Individual Income Tax Return Form. You may also Google Excel taxes for some unofficial tax tables in Excel. So in this section, we reviewed the whole alphabet of forms: 1040, Schedule F, Schedule E, 4797, Schedule 1, W2, W4, I-9, 1099, Schedule SE, and some publications that can guide you in understanding all of that. Having a good grasp of accounting for tax purposes is a great way to get your record-keeping practices moving in the right direction. However, remember that Schedule F income or losses are not a reflection of true farm income or losses. Relying on Schedule F for decision-making may lead to poor outcomes. We will see what to add to make your tax records useful for decision-making later. Let me just copy a couple links here in the chat before we go on to the next section. Okay, I'm getting a question. Does MSU Extension have a records keeping for farm booklet of forms? And I think if I'm understanding our question correctly, the answer is yes. It's the Farm Records book that I just showed you. And I think I'm about to put a link. I'm trying to copy and it's not letting me. So I don't know what I'm doing wrong. Let me try again. Yeah, okay. Yeah, I'm going to put a link. It was in the slide, but I'll put it in the chat. It wants me to copy them one by one. And there's a lot of them, so let me try again. Okay, there it goes. And finally, that last one is, you'll have to copy it and paste it on your browser, but that's the link to the Farm Records book. All right, let's go to the next section, and that is sales taxes. Earlier, we discussed the levels of accounting: taxes, financing, decision-making at the whole farm level, and decision-making at the enterprise level. The first use of accounting records is filing taxes, including sales tax. The federal government and the state government both collect income taxes. In this module, we have focused on the federal level income tax. State level income tax is usually easy to figure out once you have a handle on the federal side. Usually states, not the federal government, collect sales taxes, and local governments usually collect property taxes. So with respect to collecting sales tax, the general rule is that you have to charge sales tax on your product sales, then you give that money to the state. But the good news is that there is no sales tax on food or food ingredients unless sold for immediate human consumption. Food and food ingredients that are not subject to sales tax are substances, whether in liquid, concentrated, solid, frozen, dried, or dehydrated form, that are sold for ingestion or chewing by humans and are consumed for their taste or nutritional value. It can be cut, repackaged, or pasteurized by the seller. It can be mixed goods when sold cold by volume and with no eating utensils. And it can be bakery items, again, sold without eating utensils and cold. On the other hand, food prepared for immediate consumption, which is subject to sales tax, is that which is sold hot, or where 2 or more food ingredients were mixed for sale as a single item, or that comes with eating utensils provided by the seller. Alcoholic beverages and tobacco are also subject to sales tax. Now, with respect to paying sales tax on your supplies as a farmer, Michigan provides an exemption from sales or use tax on tangible property used in tiling, planting, caring for, or harvesting things of the soil, and in the breeding, raising, or caring of livestock, poultry, or horticultural products for further growth. So, for example, fertilizer, seed, feed, machinery, and equipment are exempt. The exemption does not include property affixed to or becoming a structural part of real estate, like permanent fencing or land or vehicles. And it obviously does not include personal property. To take advantage of this, you do not need a sales tax exempt number. The certificate of exemption may be found online at Michigan. I'm going to copy that there into the chat. So you sign a certification attesting that you are in a commercial agricultural production. The seller just attaches the signed certification to the sales receipt. If you deal with a retailer that's not used to selling to farmers, they may ask you for a sales tax exempt number because they're used to selling to other nonprofit groups. But in the case of agriculture, you do not need that number. You do not need proof that you are a commercial farm producer either. In most cases, if you're dealing with a regular agricultural retailer, they will have this built into their receipt and you just simply sign it and it's done. In some other cases, you have to provide your own certification and ask for them to attach it to the receipt. Note, however, that the tax exemption is only good for 4 years with a given vendor and will need to be filed again with that vendor to continue the exemption after that period. So in this section, we learned what product sales we have to collect sales taxes for and how to avoid paying unnecessary sales tax when making purchases for the farm. Okay, so what if we wanted to take it a step further and use our tax records to access financing, whether it is a loan or a grant? Let's spend the last few minutes on this. Financing is the second level of accounting, and it builds off of taxes, which is the first one. It doesn't provide good information on profitability, but it is a step forward in that direction. When evaluating you for a loan, a lender will usually ask for a cash flow statement and a balance sheet. In the previous sections, we learned what accounts are important to keep track of for taxes. If you build your chart of accounts based on what is needed for this purpose, your list should already have income and expense accounts like the ones on the slide. If you're keeping records for tax purposes, you are probably also keeping track of some asset accounts to report capital gains or losses and to calculate depreciation. Asset accounts used for tax filing purposes include livestock held for draft, breeding, sport, or dairy purposes, bought or raised, land, buildings, and equipment, and any retained cooperative dividends or hedging accounts you may have. With respect to liabilities, we said that any principal borrowed coming in or going out is irrelevant for taxes, but interest is a depreciable expense. So you are probably somehow keeping track of loans already. While interest is the only useful expense for taxes, for financing purposes, you will need some more information such as due dates, the duration of loans, principal balances, and amounts due and paid split between principal and interest. And so with that information alone, you can put together a cash flow statement and you're halfway ready to meet with your lender. For the balance sheet, you will need to add some more information. This includes inventories of feed, livestock, and standing and stored crops, which are asset accounts, and also those tricky or special accounts we discussed last time, which were prepaid expenses and accounts receivable for the asset side of the balance sheet and accounts payable and accrued expenses for the liability side. So to summarize, the second level of accounting is for financing purposes. You can achieve this level by using your tax information to put together a cash flow statement and adding a few more pieces to create a balance sheet. While this will take a bit more work, it can take you from a record-keeping system that's only useful for taxes to one that's also used for financing. And this sets the base for the third level of accounting management or decision-making. Okay, so let's review what is the statement of cash flows or cash flow statement. This is a summary of actual cash flows and cash like inflows and outflows during an accounting period. And this is the true value and the reason lenders ask for a cash flow statement or a cash flow projection. It shows when and by how much cash is short. And farming in general will have months with very low or negative income and months with lots of inflows. Another purpose of the cash flow statement is to summarize your overall cash flow performance. Did you have more cash coming in than going out? You'll also use the statement for cash flows to reconcile your beginning cash on hand and the ending cash on hand. And it allows you to determine what cash was used for and where it came from. You can also determine if the business had the ability to service their debt. Did you have enough cash on hand to pay out loans as they became due throughout the year? Furthermore, you can also ask questions like, is the cash generated enough to cover my family living expenses? It also allows comparison of actual cash flows with expected or budgeted cash flows, and it helps inform the creation of a cash flow budget or projection for the next accounting period. So let's take a moment to distinguish between the statement of cash flows and a cash flow budget or projection. A statement of cash flows is a summary of cash inflows and outflows over an accounting period, over a past accounting period. So these are actual amounts of cash coming in and going out that have already occurred. And a cash flow budget or projection is a chronological forecast of all expected cash income and expenses. It's forward-looking. A lender or investor might be interested in seeing both a cash flow statement and a cash flow budget or projection. The cash flow statement will inform next year's budget, and we'll also look at how we did with respect to last year's budget. So there are 5 key parts of the statement of cash flows. The first 3 main categories are cash from operating activities, cash from investing activities, and cash from financing activities. Then it will include non-farm cash flows. And finally, statements of cash flow have a section to reconcile beginning and ending cash on hand. Operating activities are all cash transactions, either income or expenses related to net income. Examples are cash paid for feed or livestock, purchased feed, and other items for resale. Cash paid for operating expenses and interest, income and Social Security taxes, and the income from the sale of market livestock and crops. Investing activities reflect cash flows resulting from the purchase and sale of capital assets like real estate, breeding livestock, machinery and equipment, buildings, titled vehicles, land, etc. Financing activities are borrowing money from creditors, repaying borrowed debts, and obtaining capital from outside sources. This includes farm and non-farm transactions. Non-farm transactions include any outside income received like wages, rents, or interest, and expenses like for family living and income and Social Security taxes. It also includes any capital contributions to or distributions from the farm or any other business and inheritance and gifts you may receive. The reconciliation section reconciles beginning and ending cash on hand. This includes cash and cash equivalents like bonds, both personal and for the farm. The net cash flow from your operating, investing, financing, and non-farm activities determines the increase or decrease in cash over the year. So the difference between beginning and ending cash should equal the total net cash flows from the first 4 sections. The financial statements are all linked together. The statement of cash flows links to the income statement, providing valuable information on cash revenues and expenses. And it also links to the balance sheet through the beginning and ending cash balances, which go in the assets section. Remember, however, that the statement of cash flows does not include non-cash transactions, which impact profitability and net worth. So it's only the first piece of the puzzle. So to summarize, in this section, we discussed the statement of cash flows. In general, if you have a positive cash flow, this means your liquid assets are increasing. This allows your business to settle debts, to reinvest, return money to owners, pay expenses, and provide a future buffer against financial challenges. Also, remember that cash flow does not mean profitability. Even profitable companies can fail if they do not have positive cash flow, for example, having large amounts of accounts receivable or a bad debt structure. All right, next, let's look at the balance sheet. The balance sheet is a report that summarizes what a business owns, which are the assets, what it owes, which are the liabilities, and the net worth or owner's equity, which is the difference between the two. Sometimes it's also called the net worth statement. It's based on the fundamental accounting equation of assets equal liabilities plus owner's equity. And it's a snapshot of the financial position of the farm business at a given point in time. So the balance sheet shows your financial position and your ability to handle risk. It allows you to calculate your net worth and a few solvency and liquidity ratios. Solvency is the ability to pay long-term debt and represents your farm's ability to thrive in the long term. And liquidity means the ability of a business to meet its immediate financial obligations as they become due without disrupting its activities. Although the balance sheet is a snapshot, looking at a series of balance sheets over time allows you to track and monitor your financial progress. How has your net worth changed in the past 5 years? Has it been growing, shrinking, or volatile? That sort of thing. We're going to look more at solvency and liquidity in the next webinar. But within the balance sheet, it is important to keep farm and non-farm assets and liabilities separate. Most farm balance sheets will break both assets and liabilities into either 3 categories, current, intermediate, and long-term, or 2, grouping intermediate and long-term assets into a single category called non-current or term. Assets are all the things owned or owed to the business as of the date of the balance sheet. There may be a liability against the asset, and in that case, the asset will appear in the asset section and the liability will appear in the liability section of the balance sheet. Current assets are cash and other assets that you expect to receive, convert to cash, or consume in production during a business year. Examples are crops, market livestock, prepaid expenses, cash, savings, and accounts receivable. Intermediate term assets are those resources intended to support production rather than go for immediate sale. They are expected to have a useful life of 1 to 10 years and are machinery, vehicles, breeding livestock. And long-term assets include items of a more permanent nature, such as farmland, buildings, improvements, and co-op shares. 2 valuation methods are used for assets: cost value and market value. The market value is the amount that you will receive if you sold the asset on the open market. The cost value is the purchase price minus a standard percent of economic depreciation, and it's a much more conservative estimate. Some argue that tax valuation should also be listed, showing the remaining undepreciable tax basis or undepreciated tax basis. So what you paid for it minus tax depreciation claimed. Market and cost values are the same for current assets, but as time goes by, they can be very different for non-current assets like farmland bought 3 generations ago. We recommend using both. Lenders want to see market value so they can determine loan collateral. It's also valuable to compare farm business, like farm investment, to other farm or non-farm investment options, the market values. But To analyze an existing business where the farm manager is attempting to track financial progress over time using cost values is more meaningful. Market values can be misleading in determining profitability and monitoring financial progress, as they will be affected by inflation or deflation, as well as actual earned income. The cost value balance sheet is not affected by inflation or deflation and is more useful in monitoring progress in profitability, since only the changes in net worth resulting from earnings are included. So having both cost and market valuation balance sheets allows the manager to see where equity is coming from, retained profits or inflation. Liabilities are all debts that are owed as of the date of the balance sheet. Current farm liabilities are those due and payable on demand within the operating year, which include commodity credit and operating loans, accounts payable, accrued expenses, unpaid bills, and payments on longer terms to be made in the next year. Intermediate liabilities and debts are against intermediate assets, machinery, breeding, livestock, and perhaps buildings. These typically are due within 10 or 7 years at least. Long-term liabilities are against long-term assets. This will usually include loans, land contracts, or mortgages for the purchase of long-term assets such as land, buildings, and other permanent land improvements. These typically were set up originally with 10 or more years to repay. The last section of the balance sheet is owner's equity or net worth. This is the share of the business that the owner owns outright. If you were to sell all of your assets and pay back all of your liabilities, this would be the amount left over that you would be able to walk away with free and clear. This is really what you are interested in seeing grow over time. Sure, you would like your assets to increase over time as well, but at the same time, you might have more liabilities to pay for those assets. So really, you're interested in the difference between the two. The owner's equity section has just a few lines, as it only changes when the business has a profit or loss called retained earnings, or when the owner invests more capital from outside the business, or withdraw money from the business called contributed capital or owner draws, or when assets in the balance sheet change value. By looking at this change in asset values, we can understand how inflation of assets or appreciation is impacting our financial position. And we track both cost and market values to be able to calculate these changes. Okay, so that's the balance sheet. It may seem like a lot if you are doing it for the first time, but once you've done it once, it will become easier. You do not need to keep any statements necessary. You do not need to keep detailed track of that information for your balance sheet throughout the year, but you do need to keep any statements necessary to put it together at the end of the year. Or if you have an important management decision to make, or as you're preparing to meet with your lender. So summarizing, the balance sheet helps you look at your financial position at its particular time, and you can also compare that to previous years using trend analysis. It also contributes to financial analysis. However, you can't look at the balance sheet in isolation because the balance sheet doesn't necessarily tell you if the farm made money this year. To be able to tell, the balance sheet feeds into your income statement through accrual adjustments, which we'll learn more about next time, and it incorporates retained earnings from the profit shown in the income statement. So that's it for the presentation part. Thank you for bearing with me as I spoke and spoke and spoke. I do have a question that says, with an S Corp, you don't do draws for family expenses, correct? That is taken care of through salary. And yes, that is correct to my understanding. I see that Corey, my colleague, Corey Clark, is here, and she used to teach this presentation with me, and she is an expert in Texas. So Corey, if you have heard me either say something wrong, or if you want to add anything, you would be more than welcome to unmute and say something. Other than that, are there other questions or comments? I did want to put 3 more things in the chat. It's the Michigan, well, they are not linked, but hopefully if you need them, you can copy and paste them, and they will be in the resources I sent afterwards. but they are about Michigan taxes. And there's also a link to an article by our colleague, John Laporte, about what the lender may be looking for. You're welcome, Ron or Margie. What else? Oh, I do have a link here to an evaluation survey. So if there's anything good or bad you want to say about today's presentation, please put it there. You're welcome, everyone. Are there any other questions that you may want to ask? Comments, struggles in your farm? You're all welcome. Thank you for saying thank you. All right. Well, if there aren't any questions, I will give you 5 minutes back. Oh, okay. I'm getting it. I can't see your comment, Precious. You're just starting, so wish you luck. I do wish you luck. And I think you were part of the farm business record keeping for the global majority group? I think I recognize your name from that other program. And if that's true, then I'm glad I was, okay. Yeah. So yeah, it's a lot. And this is stuff that will need to be, that I need to hear over and over and over. And even ourselves as educators, we go through training every year because it's just a lot. And we tend to forget also because taxes are only done once a year and then we move on. And so, yeah, there will be the recording available and all of the resources. So hopefully that helps a little bit. All right. Okay, I'll just let you all go. Thank you for joining me again today. And please, if you're able, fill in those forms, the race and gender one and the evaluation survey. I would really appreciate that. I'll also send everything in an email afterwards. So have a good rest of your day, and we'll see you in the next one, which may be a week from today. Let me just check that. Yep. Next one is next Monday, and we're going to do farm business analysis and benchmarking. So if you want to come to that one, you are very welcome. And thank you very much, Corey, for your message. All right. Take care, everyone.